Hey, Dan Passarelli here. Well, the market ended up taking a little bit on the chin today. The S&P 500 fell about 1.8% by the end of the day. And a lot of that has to do with worry about the monthly unemployment number that comes out tomorrow. That's kind of the big one. Probably the biggest focus of the Fed. That, of course, and inflation numbers. And so all eyes are on that. And there's been definitely a risk-off mood as a result of that. Now, a couple other things that came into play here are this. We talked about this a few days ago. The 50-day moving average here on this SPY chart has been a pretty key area. We've fallen below it in the past a few days ago, but then made it above it. And now we tested it again today and pretty decisively on high volume. And in fact, we actually closed below the 200-day moving average, which is kind of a big deal. Now, it's okay for something to cross through the 200-day moving average, which it did here and here. But a lot of times when it crosses, it can really stay on the other side of that for a while. Now, we did here, but this is not a while. When I say a while, I'm talking about a while. Right. So tomorrow's session after the unemployment number, whatever happens there, is going to be a real deciding day, I think. If we sell off pretty hard, we could be looking at trending to the downside for a bit. But if we get some good news and the market reverses, it could be fine, and I think we could shake this off pretty quick. Now, another thing that incites a bit of worry here is the VIX. Now, the VIX has been, I was just emailing with one of our student traders who's attended our mastermind before earlier today about this, that I was just shocked that volatility has been so low across the board, implied volatility. In a lot of cases, implied volatility has been trading below historical volatility, and it really hasn't been making any sense. However, the market got spooked enough for the VIX to return to a level where arguably it probably should be, 2240. So we're going to not just be watching the 50-day and 200-day moving averages tomorrow from a technical standpoint. We're going to be not just watching the unemployment tomorrow from a fundamental standpoint, but from a volatility standpoint. We're going to be keeping an eye on the VIX because this gives us an indication of are the hedgers back. Now, that said, how do we trade this? Well, I've really spoken more from a longer-term directional standpoint, more for your investing, your IRA, and hey, that's going to come back in the long run, right? So as far as trading goes, a couple of things. One, I think if we do make a move to the downside, that could end up actually being really great. Why? Because implied volatility will continue to rise. And in SPY and in other stocks, we've got lots of support levels down below because we've tested those already. In spiders, we've got 380, we've got about 370, and really right around here at about 356 or 7 or so. So to the downside, I'm going to love put credit spreads in spiders and some other names. But if it heads back up to the upside and stays above the 200-day moving average, we're going to feel a little bit more safety. We might see the VIX come off a little bit and get a little bit lower. But we've got plenty of areas to the upside that were recently tested that will act as resistance that will make for nice call credit spreads. Now, if you are not an expert with call or put credit spreads, or maybe even if you are, but you have enough humility that you want to get better at your craft, which I recommend you strive to always do. And if you haven't seen our presentation, our special online training on credit spreads, we're having an encore presentation of that on Saturday, and I want you to attend. You can register for it at this link that pops up right after this. This is Dan Passarelli, Trade Smart, and I'll see you on the online training on Saturday morning.